Welcome to the fascinating world of accountancy. We're about to embark on a 30-minute journey to master the essentials of +1 accountancy. Accountancy is often called the language of business. It is the system we use to track and understand financial transactions. Just like learning any new language, it might seem a little intimidating at first. But trust me, once you grasp the fundamental concepts, it becomes surprisingly intuitive and even enjoyable. In this whirlwind tour, we'll break down complex topics into bite-sized pieces, making them easy to digest. Think of this as your crash course, your cheat sheet, your secret weapon to conquering +1 accountancy. So buckle up, get ready to learn, and let's dive right in. Accountancy is more than just numbers on a page. It's the story of a business. It tells us how a business is performing, where its money is coming from, and where it's going. Imagine you're running a lemonade stand. Accountancy would help you track how many glasses you sell, how much money you make, and how much profit you're left with after buying lemons and sugar. It's about understanding the financial health of an organization, whether it's a small lemonade stand or a multinational corporation. Accountancy is used everywhere, from small businesses to large corporations, and even in our personal lives. When you create a budget, you're essentially engaging in accountancy. You're tracking your income, expenses, and savings to make informed financial decisions. It's a fundamental skill that empowers you to make smart choices with your money, both personally and professionally. Now, you might be wondering, why is accountancy crucial for students, especially at the +1 level? Well, for starters, a strong foundation in accountancy is essential for many career paths. Whether you dream of becoming an entrepreneur, a financial analyst, a manager, or even a doctor, understanding financial information is crucial for success. Moreover, +1. Accountancy equips you with valuable life skills. It teaches you how to manage your personal finances, analyze financial statements, and make informed investment decisions. These skills are invaluable in today's world, where financial literacy is becoming increasingly important. So, whether you're aiming for a career in finance or simply want to manage your money wisely, +1 accountancy is a stepping stone to a brighter future. +1 accountancy is your gateway to the fascinating world of finance and business. It introduces you to the fundamental concepts and principles that underpin the entire field. Think of it as laying the groundwork for a strong building. The stronger your foundation, the higher you can build. We'll cover everything from basic accounting terms and principles to the double entry system, financial statements, and even some common accountancy problems. By the end of this session, you'll have a solid understanding of the core concepts and be well equipped to tackle more advanced accountancy topics in the future. Remember, learning accountancy is like learning a new language. It takes time, practice, and patience. But with the right approach and a little effort, you'll be surprised at how quickly you can master the basics. Section 5. Setting the stage for success. Our goal for this 30-minute session is to demystify accountancy and make it accessible to everyone. We'll use simple language, relatable examples, and clear explanations to ensure you grasp each concept before moving on. Don't be afraid to ask questions, take notes, and most importantly, enjoy the learning process. We'll break down each concept into manageable chunks, starting with the basics and gradually building up to more complex topics. Think of this as a journey, and we're in this together. So, get ready to embark on an exciting adventure into the world of +1 accountancy. Welcome to Act 1 of our 30-minute accountancy adventure. In this act, we'll lay the foundation for your accountancy knowledge by exploring the basic building blocks of this fascinating field. Just like a house needs strong bricks and mortar, a solid understanding of accountancy requires a firm grasp of its fundamental concepts. Imagine accountancy as a giant puzzle. Each piece represents a different concept, and together they form a complete picture of a business's financial health. We'll start by defining key terms like assets, liabilities, equity, revenue, and expenses. These terms are the building blocks of financial statements, the reports that provide a snapshot of a company's financial position. Don't worry if these terms sound intimidating at first. We'll break them down into simple, easy-to-understand explanations. By the end of this act, you'll be able to confidently navigate the world of accountancy, armed with a clear understanding of its fundamental elements. So let's start building our accountancy foundation, brick by brick. Our first building block is assets. Think of assets as anything a business owns that has value. This could be something tangible like cash in the bank, inventory in a warehouse, or equipment in a factory. Assets can also be intangible like patents, copyrights, or even the goodwill a business has built up over time. Essentially, if you can touch it or legally claim it and it has a monetary value, it's likely an asset. For example, imagine you own a bakery, your oven, your cash register, the flour in your pantry. These are all assets because they hold value and contribute to your ability to generate income. Even the secret recipe for your famous chocolate chip cookies, while not something you can physically touch, is considered an asset because it gives your business a competitive edge. Understanding assets is crucial because they represent a company's resources, its potential to generate revenue, and ultimately, its financial strength. The more assets a business owns, the more resources it has at its disposal to operate and grow. Now let's talk about the flip side of assets: liabilities. Liabilities are what a business owes to others. Think of it as the company's debts or obligations. This could include loans from a bank, unpaid bills from suppliers, or even salaries owed to employees. Equity, on the other hand, represents the owner's stake in the business. It's the portion of the company's assets that the owner actually owns, free and clear of any debts. Think of it as the difference between what the business owns, assets, and what it owes, liabilities. For example, if your bakery has $10,000 in assets and $4,000 in liabilities, your equity would be $6,000. This means that out of the $10,000 worth of assets, you own $6,000 outright, while the remaining $4,000 represents your obligations to others. Understanding liabilities and equity is crucial for assessing a company's financial risk. A company with high liabilities compared to its equity is considered riskier because it has a larger debt burden to manage. Now that we've covered the basics of what a business owns and owes, let's talk about the flow of money, revenue, and expenses. Revenue is the income a business generates from its operations, primarily from selling its goods or services. Expenses, on the other hand, are the costs a business incurs in the process of generating that revenue. This could include the cost of goods sold, salaries, rent, utilities, and other operating expenses. Going back to our bakery example, your revenue would be the money you earn from selling your delicious pastries. Your expenses would include the cost of ingredients like flour and sugar, the rent for your bakery space, and the wages you pay your bakers. Understanding the relationship between revenue and expenses is crucial for determining a business's profitability. Profit is simply the difference between revenue and expenses. If a business generates more revenue than expenses, it's profitable. If expenses exceed revenue, it's operating at a loss. Now let's dive into the heart of accountancy, the double entry system. This system is the backbone of modern accounting, ensuring that every financial transaction is recorded accurately and completely. Think of it as a set of scales, always striving for balance. The double entry system is based on a simple yet powerful principle. For every action, there's an equal and opposite reaction. In accounting terms, This means that for every debit, there must be a corresponding credit. Don't worry, we'll unpack what debits and credits actually mean in a moment. This system ensures that our accounting equation, assets equals liabilities plus equity, always remains balanced. Every transaction we record will affect at least two accounts, and the total debits will always equal the total credits. This might seem a bit abstract right now, but trust me, once we start working through examples, it will become crystal clear. So buckle up, and let's unravel the mysteries of the double entry system. Section 2, Debits and Credits, not good versus bad. Let's demystify debits and credits. In accountancy, debit means the left side and credit means the right side. Debit increases asset accounts, while credit decreases them. For liabilities, it's the opposite. It's a simple dance between debits and credits. To navigate debits and credits, remember the golden rule of double-entry bookkeeping. Every transaction must be recorded in two accounts, with at least one debit and one credit. The total value of debits must always equal the total value of credits, ensuring our accounting equation remains balanced. Think of it like a seesaw. If we add weight to one side, we must add an equal weight to the other side to maintain balance. For example, borrowing money increases assets, cash, and liabilities, loan payable. We record this by debiting the cash account and crediting the loan payable account. This ensures our financial records are accurate and reliable. Mastering this rule is essential for understanding the double entry system. Let's bring the double entry system to life with a practical example. Imagine you own a clothing store and purchase $1,000 worth of new inventory from a supplier on credit. This means you're not paying for the inventory immediately, but will settle the payment later. This transaction affects two accounts, inventory, an asset, and accounts payable, a liability. Here's how we record it using the double entry system: debit inventory, asset, $1,000. Credit accounts payable, liability, $1,000. We debit inventory because we've increased our assets by receiving $1,000 worth of new merchandise. We credit accounts payable because we've incurred a liability to pay the supplier $1,000 at a later date. Notice how the total debits, $1,000, equal the total credits, $1,000, maintaining the balance in our accounting equation. This simple example illustrates how the double entry system ensures that every transaction is recorded accurately and completely, reflecting the flow of value within a business. Let's look at another example. Suppose you pay your employees $2,000 in salaries for the month. This transaction affects two accounts: salaries expense, which is an expense, and cash, which is an asset. Here's how we record it using the double entry system: debit salaries expense and expense $2,000. Credit cash and asset $2,000. We debit salaries expense because we've incurred an expense of $2,000 by paying our employees. We credit cash because we've decreased our assets by paying out $2,000. Again, notice how the total debits, $2,000, equal the total credits, $2,000, maintaining the balance in our accounting equation. This example highlights how the double entry system captures both sides of every transaction, ensuring that our financial records accurately reflect the flow of money within a business. Section 6. Practice makes perfect. The key to mastering the double entry system, like any new skill, is practice. The more you practice recording different types of transactions, the more intuitive the process will become. Don't be afraid to make mistakes. That's how we learn. Think of it like learning a new dance move. At first it might seem awkward and confusing, but with repetition and guidance, you'll eventually be able to glide through the steps with ease. In the next act, we'll build upon our understanding of the double entry system and explore how these recorded transactions come together to form the foundation of financial statements. Get ready to see the bigger picture of how accountancy helps us analyze a company's financial health and performance. Welcome to Act 3, where we'll transform raw accounting data into meaningful insights through the magic of financial statements. Think of financial statements as the captivating stories that numbers tell, revealing the financial health and performance of a business. Just like a good story, financial statements have a beginning, a middle, and an end, each part providing a different perspective on the company's journey. Remember all those transactions we meticulously recorded using the double entry system? Well, those entries form the backbone of these financial statements. We'll explore how those debits and credits culminate in these reports, providing a comprehensive picture of a company's financial position. Financial statements are essential tools for decision-making, both for internal stakeholders like managers and employees, and external parties like investors, creditors, and regulators. They provide a standardized language for communicating financial information, allowing everyone to understand and analyze a company's performance. So, let's delve into the world of financial statements and unlock the valuable insights they hold. In financial statements, three reports take center stage: the balance sheet, income statement, and cash flow statement. The balance sheet shows assets, liabilities, and equity at a specific time. The income statement summarizes revenue, expenses, and profit over a period. The cash flow statement tracks cash movement in and out of the company. Let's start with the balance sheet, our financial snapshot. Remember the accounting equation, assets equals liabilities plus equity? Well, that's the foundation of the balance sheet. On the left side, we have assets listed in order of liquidity, meaning how quickly they can be converted to cash. Current assets like cash, accounts receivable, and inventory are expected to be converted to cash within a year. Non-current assets like property, plant, and equipment have a longer lifespan. On the right side, we have liabilities and equity. Liabilities are listed in order of their due date, with current liabilities, like accounts payable and salaries payable, due within a year. Non-current liabilities, like long-term loans, have longer maturities. Equity represents the owner's stake in the business, reflecting the residual value after liabilities are subtracted from assets. The balance sheet provides a quick overview of a company's financial health, showing its resources, obligations, and the owner's investment. It helps stakeholders assess the company's liquidity, its ability to meet short-term obligations, and its overall financial risk. Now let's move on to the income statement, our profitability tracker. The income statement follows a simple formula. Revenues minus expenses equals net income or loss. At the top, we have revenues, representing the income generated from selling goods or services. Below revenues, we deduct expenses, representing the costs incurred to generate those revenues. Common expenses include the cost of goods sold, salaries, rent, utilities, and depreciation. The difference between revenues and expenses is our net income, also known as profit or the bottom line. A positive net income indicates profitability, while a negative net income represents a loss. The income statement provides valuable insights into a company's operating performance, showing its ability to generate revenue, control costs, and ultimately generate profit. It helps stakeholders assess the company's efficiency, profitability, and overall financial sustainability. Finally, let's explore the cash flow statement, our cash flow monitor. This statement tracks the movement of cash, the lifeblood of any business, regardless of its profitability. The cash flow statement is divided into three sections: operating activities, investing activities, and financing activities. Operating activities reflect the cash flows generated from a company's core business operations, like selling goods or services and paying operating expenses. Investing activities involve the purchase and sale of long-term assets, like property, plant, and equipment. Financing activities include transactions related to raising capital and repaying debt, like issuing stock, borrowing money, and paying dividends. The cash flow statement provides a clear picture of a company's cash generation ability, its investment decisions, and its financing strategies. It helps stakeholders assess the company's liquidity, its ability to fund growth, and its overall financial flexibility. Section 1. Troubleshooting your accountancy journey. Welcome to Act 4, where we'll put on our detective hats and tackle some common accountancy problems that often trip up even the most diligent students. Think of this as our troubleshooting session, where we'll diagnose those accounting headaches and prescribe clear solutions to help you get back on track. Just like in any subject, encountering challenges is a natural part of the learning process in accountancy. It's those aha moments when we overcome obstacles that our understanding deepens and our skills truly sharpen. We'll address frequently asked questions, unravel common misconceptions, and provide step-by-step solutions to guide you through those tricky accounting scenarios. Remember, there's no shame in seeking help when you need it. In fact, it's a sign of a proactive and engaged learner. We'll also explore some valuable resources available to you, ensuring that you have all the support you need to succeed on your accountancy journey. So, let's dive into those common accountancy problems and emerge as confident accounting sleuths. One of the most common stumbling blocks for accountancy newcomers is understanding the concept of debits and credits. Remember, in the world of accounting, these terms don't carry the same connotations as they do in everyday language. Forget about good and bad or positive and negative. The key to conquering this confusion is to remember the fundamental rule. Debit simply means the left side of an account, while credit means the right side. To solidify this concept, try using visual aids like T-accounts, where you can clearly see the debit side on the left and the credit side on the right. Another helpful tip is to focus on the type of account affected and whether the transaction increases or decreases its balance. For example, remember that a debit increases the balance of asset, expense, and dividend accounts, while a credit increases the balance of liability, equity, and revenue accounts. Practice makes perfect. The more you work through examples and apply the rules of debits and credits, the more intuitive they will become. Another common pitfall is misclassifying accounts, such as mistaking an asset for a liability or an expense for revenue. Accurately categorizing accounts is crucial because it directly impacts the accuracy of our financial statements. To avoid this error, take the time to carefully analyze each account and its purpose. Ask yourself, what does this account represent? What type of transactions affect it? For example, if an account represents something the business owns and it has a future economic benefit, it's likely an asset. If it represents something the business owes to others, it's likely a liability. Refer to the chart of accounts, a comprehensive list of all account titles used by a company, for guidance. Don't hesitate to seek clarification from your teacher or classmates if you're unsure about the classification of a particular account. Remember, accuracy is key in accountancy, and even a small misclassification can have a ripple effect on the overall financial picture. Adjusting entries, those end-of-period adjustments we make to ensure our accounts are up to date and reflect the correct financial position, can also pose a challenge. These entries are crucial for recognizing revenues when earned, expenses when incurred, and for matching expenses with the revenues they help generate. One common difficulty is identifying which accounts need adjusting. Remember, we make adjusting entries to account for transactions that span multiple accounting periods, such as prepaid expenses, unearned revenues, accrued expenses, and accrued revenues. Another hurdle is determining the correct amounts for the adjustments. This often involves calculating portions of expenses or revenues that belong to the current accounting period. Practice identifying and preparing different types of adjusting entries using real-world examples. Focus on understanding the underlying concepts of accrual accounting and matching principles to strengthen your grasp of this crucial aspect of accounting. Financial ratios, those powerful tools that help us analyze a company's financial health and performance, can sometimes feel like deciphering a secret code. These ratios express the relationship between different pieces of financial information, providing valuable insights into a company's profitability, liquidity, solvency, and efficiency. The key to unlocking the insights hidden within financial ratios is twofold: understanding what each ratio measures and knowing how to interpret the results. Start by familiarizing yourself with common financial ratios such as the current ratio, debt-to-equity ratio, and return on equity. Once you understand what each ratio measures, focus on interpreting the results in context. Compare the company's ratios to industry averages, its own historical ratios, and the ratios of its competitors to gain a comprehensive understanding of its financial health and performance. Remember, financial ratios are most insightful when used in combination rather than in isolation. By analyzing multiple ratios together, you can paint a richer and more nuanced picture of a company's financial story. Section 6. Seeking help. Resources for success. Encountering challenges in accountancy is perfectly normal, and it's important to remember that you don't have to navigate these hurdles alone. A wealth of resources is available to support you on your accountancy journey, providing guidance, clarification, and additional practice. Start by utilizing your textbook and class notes, paying close attention to examples and practice problems. Don't hesitate to ask your teacher for clarification on any concepts that feel unclear or for additional practice exercises. Explore online resources such as Khan Academy, Accounting Coach, and Investopedia, which offer clear explanations, video tutorials, and interactive quizzes. Consider forming a study group with classmates to work through problems together, share insights, and reinforce each other's understanding. Remember, the key to mastering accountancy is to stay engaged, ask questions, practice consistently, and seek help when needed. With dedication and the right resources, you can conquer those accounting challenges and emerge as a confident and capable accounting whiz. Congratulations on completing this whirlwind tour of Plus One Accountancy. In just 30 minutes, you've journeyed through the fundamental concepts, tackled common problems, and emerged with a solid foundation in this essential field. Remember that feeling you get when you finally solve a tricky math problem or grasp a complex concept? That's the power of learning. And you've just unlocked a valuable skill that will serve you well in all aspects of your life. Think back to when we first embarked on this journey. Accountancy might have seemed like a daunting mountain to climb, filled with unfamiliar terms and complex rules, but step by step, concept by concept, we broke down those barriers and demystified the world of accounting. You learned about the building blocks of accounting, the importance of the double entry system, the insightful stories told by financial statements, and even how to troubleshoot common accounting dilemmas. You've come a long way in a short amount of time, and that deserves a round of applause. But our journey doesn't end here. The journey of 1,000 miles begins with a single step. Your mastery of accountancy starts with consistent practice. Exercise your accounting brain like an athlete trains muscles. Practice makes perfect. The more you practice, the more intuitive it becomes. Every problem you solve brings you closer to mastery. Section 3. Embrace the power of accountancy. As we conclude our 30-minute accountancy adventure, it's important to remember that accountancy is more than just numbers on a page. It's a powerful tool that empowers us to make informed decisions, navigate the complexities of business, and achieve our financial goals. Whether you pursue a career in finance, start your own business, manage a household budget, or simply want to be a more informed investor, the skills you've gained in Plus One Accountancy will serve as invaluable assets throughout your life. Embrace the power of accountancy to unlock new opportunities, make sound financial choices, and achieve your dreams. Remember, the world of business and finance speaks the language of accounting, and you're now equipped to understand and navigate this dynamic landscape. So go forth with confidence, embrace the challenges ahead, and never stop exploring the fascinating world of accountancy.